All right, let's talk about two of the most fundamental tools in any trader's toolkit, the simple moving average and the exponential moving average. We're going to break down the core difference between them and hopefully help you figure out which one is right for your strategy. Let's get into it. So this is the big question, right? Simple or exponential? You'll find people who swear by one or the other, but is one really, better? Well, by the end of this, you're going to know exactly how each one works and, more importantly, which one is probably the right fit for your personal trading style. Okay, first up, let's talk about the foundation. This is the simple moving average, or SMA. It's kind of the baseline, the tool most traders learn first, and honestly for a very good reason. So what does it actually do? Well, the SMA's main job is to smooth out all that chaotic price action you see on a chart. It just calculates a simple average price over a time period you choose, which filters out all the short-term market noise and gives you a much clearer look at the underlying trend. And the calculation? It's literally as simple as its name. If you want a 20-period SMA, you just add up the closing prices of the last 20 candles and divide that total by 20. That's it. That simple math is really the key to understanding how it behaves. Now, you'll see traders using a few standard periods to get a read on different trends. The 20 SMA, for example, is great for short-term direction. But the big one, the 200 SMA, well, that's like a major benchmark that almost everyone watches to see what the overall market is doing. And all of this leads to the SMA's big trade-off. Because it gives equal weight to all the data, it creates this really nice smooth line on your chart. But that smoothness comes at a price. It's slower. It takes a while to react to sudden price moves. So remember that, smoother but slower. Okay, now let's bring in the challenger, the exponential moving average, or EMA. This was basically created to solve the SMA's biggest weakness, that slow reaction time. And this right here is the game changer. While the SMA treats all prices the same, the EMA gives way more weight and importance to the most recent price action. The math is a bit more complex, but the idea is simple. Older price data fades in importance. This makes the EMA way more responsive to what's happening in the market right now. But here's the thing about the EMA. It's kind of a double-edged sword. The huge pro is that it reacts fast, which could get you into a new trend much earlier. The con? That same sensitivity means it can get faked out by little blips in a choppy, sideways market, which can lead to a lot more false signals. Okay, so now that we've met them both individually, let's put them side by side in a direct head-to-head comparison. This is where it'll all really click. When you boil it all down, the difference really comes down to three things: weighting, speed, and smoothness. The SMA is democratic. Every price gets an equal vote. The EMA is biased. It cares way more about recent prices. And because of that, the SMA is slow and smooth, while the EMA is fast and sensitive. Look, if you remember just one thing from all this, let it be this. SMA is smoother but slower. EMA is faster but more sensitive. Think of the SMA as a giant steady cargo ship. It gives you a stable view of the long journey. The EMA is a nimble speedboat, reacting instantly to every single wave. So theory is great, but how does this actually work in the real world? Well, choosing the right tool for the job really depends on your own trading style. It connects directly to your strategy. If you're a long-term trend follower, someone who wants to ride the big moves and just ignore the day-to-day noise, the SMA is probably going to be your best friend. But if you're a short-term momentum trader trying to catch those quick bursts, you need the responsiveness of the EMA. And because it's so responsive, the EMA is perfect for a few really popular strategies. You've probably heard of crossover systems, right? That's where a short-term EMA crossing over a long-term one can signal a new trend. It's a classic for a reason. All right, let's pull all this together. We've gone over the mechanics, we've talked strategy, so now let's just lock in this whole concept with one final really powerful analogy. I absolutely love this analogy because it just makes everything click. The SMA is like the average temperature for the whole last week. It tells you the general season you're in. The EMA, that's today's temperature. It tells you whether you need to grab a jacket right now. So at the end of the day, there is no winner in the SMA versus EMA debate. There's no secret best indicator. The best one is simply the one that works with your plan, your time frame, and your goals. They're just different tools in the toolkit, and each one is suited for a different job. So now the ball is in your court. You understand the difference. The real question is, which indicator fits your strategy? Do you need that smooth, stable path of the SMA, or do you need the fast, responsive signals of the EMA? The answer isn't out here, it's in your own trading plan.